Hello everyone, this is Market Daily where I bring you the latest in trends and money. Please subscribe and hit the notification bell for more contents and research. Your support to go a long way. The rising bond yield once again hit stock really hard this week and Nasdaq took much harder bidding than Dow Jones. I want to introduce to you some stocks that might help you to worry a bit less about this strange period in America. Some of you might be wondering why rising bond yields and inflation pull stock down. Well, to put it bluntly, there are two reasons for this. One, it is the older investors who are about to retire or already retired with less risk tolerance and they were thick and fat 401k piling into bonds, trying to secure stable cash flow for their retirement or their remaining year. So in order to buy bonds, they have to sell more stocks, thus forcing the price to go down. Now imagine you are 70 years old or 60 years old and in March last year, you see your money vanish 35% and only to see it recover within the same year. But if you're so old, you only have like 10 years to 20 years to live. Why do you want to invest in something to make more money? Do you want to invest in some company that will increase hugely in price? No, you don't. You want to keep your cash stable and safe so that you can spend until you die. And two, rising inflation makes the cost of capital more expensive and higher rates hurt high growth stocks more than others because high growth companies generate most of their cash flow far in the future. Higher rates reduce the present value of that cash. Hence, the selling of big tech names such as a FANG group when there is nothing fundamentally wrong with their business. Now, when there is inflation in the US, there might not be inflation in China or any other emerging market since there wasn't any money printing to its citizens as a stimulus packages. So I went through this list of Chinese companies listed on major stock exchange in the US and I found some very interesting stocks. Today I'm going to discuss FINV Group, ticker symbol FINV, and reason why I think it is hugely undervalued right now. FINV is a Shanghai-based micro lender that mainly serves young borrowers in lower tier cities throughout China. The company specializes in short-term uncollateralized loans to borrowers who have difficulties accessing credit via the former banking sectors. The company was formerly known as PPDAI and founded in 2007. It was the first and for the time one of the largest peer-to-peer lending platforms in China. The business model at the time was to match individual borrowers with individual investors. The peer-to-peer industry grew rapidly in the first half of 2010s, and by 2016 there was over 3,000 platforms in operation. Fraud of individual investors was widespread in the sectors, and starting in 2016 financial regulators in China began to crack down. In the following years, most peer-to-peer lending platforms were forced to close down, and the largest players have since abandoned the peer-to-peer business model and pivoted to funding loans from institutional sources, a process which FINV has now completed. As part of this transformation, the company was renamed FINV in November 2019. At the end of 2020, the company had 116 million cumulative registered users. That's like half of America's population, and an outstanding loan of 26.4 billion China yuan, which converts to about 4 billion USD, making it largest micro lenders in China. All loan outstanding are now funded by institutional partners, mainly domestic bank and trust companies. Now, why do I think this company is a great investment? For the start, the company has 8% shares by the insiders and 28% owned by institutions with large names such as Wells Fargo, L1 Capital, BlackRock, just to name a few. Now this shows that the company has received much confidence from the large American institution. And secondly, loan volume saw strong growth in 2020 and risk management remained prudent. And also recently with Ant Finance, which is owned by Jack Ma, being hit hard by the government, there is more room for growth for FINV. And the company is very profitable too. You can see it has net margin of 33% and return on invested capital 8.71%, which is huge. And on top of that, revenue grew at 60% every year for the last 3 years, and operating income double every single year. Okay, so let's talk about the risk in investing in this company. So the company was listed in 2017 and was priced at around $13 a share. It has been steadily beaten down since then, reaching a low of 1.3 in March 2020. I believe the extreme bearishness on the stock at the time was due to three factors. One, pessimism on former peer-to-peer lending platform and on micro lenders in general, following several years of regulatory tightening in China. And two, concerns about the impact of COVID-19 on assets quality. And three, skepticism on Chinese stocks in general, following high-profile accounting scandals such as Luckin Coffee. The regulatory environment is still evolving, but the worst is probably behind FINV. A series of directives regulating online lenders were released recently by the People Bank of China and the China Banking and Insurance Regulatory Commission. These limits the ways lenders like FINV can operate, but also implicitly recognize their right to operate, which is a very positive development. There remains some uncertainty about the potential cap on interest rates charge on consumer loan. A directive issued in Supreme People Court in August 2020 set a cap of 15.4% for consumer lending, down from 24%. It's not clear that this cap applies to companies like FINV. I expect these issues will be cleared up over the coming year. I'm cautious when it comes to Chinese company too, but I think FINV is less likely to have major carrying issues given the level of regulatory scrutiny it has been under in China. I believe there is substantial upside for FINV despite the recent run-up in its stock price. Well, I absolutely think this is undervalued. And look at the peer. We have 360 Digitech, ticker QFIN. It has PE ratio 11.3, and then we have Lexin Fintech Holdings, ticker LX. It has a PE ratio of 30, which is much higher than FINV with the lower customer base. So there are two things. One, large institution holders, and second, very low PE compared to its peers. So in conclusion, I like FINV because of its history of profitability over the last 10 years operating in the subprime borrower market segment. The company also has the largest registered borrower base among its peers. So my target price is around $16 a share. I expect multiple expansion for FINV as well as for other micro lenders in China going forward as the regulatory environment stabilizes. Anyway, do your own due diligence before getting into this high growth stock. If you liked the video, please like and subscribe for more contents and research. Thank you and goodbye for now.